Welcome to Angels at Essex, the University of Essex. We are just waiting for people to join us, so please be patient. Just give us a minute or so whilst we wait for people to join this webinar. Welcome to all those who are currently joining this webinar. We will be starting in approximately a minute or so, just as people join us. So please be patient. Thank you. Welcome to Angels at Essex. This is our investment readiness program, and today we're talking about exit strategies. We're just waiting for the last minute or so for people to join us. There's always a short delay, but please be patient. Welcome, everybody. We are about to start. Welcome to Angels at Essex. My name is John Stenhouse, and I'm the Business Support Manager running the Investment Readiness Program and Angels at Essex, our equity investment platform. Our webinars are actually recorded, so they will be made available on YouTube as soon as we can upload them, but the YouTube channel is currently live and has our previous webinars in this series available to view. Please use the Q&A if you have any questions. The Q&A is your opportunity to ask those questions, most demanding or otherwise, of our guest speaker or myself, and we will endeavour to answer all questions during the course of this webinar. We'll leave most of them to the end, but some of them may be answered as part of the presentation. But there is no such thing as a silly question, so please just ask. This is your opportunity to listen and learn. Angels at Essex has had a successful 3-year run, and we are pleased to announce that we have raised over 33 million for businesses in innovative and early seed stage situations. But of course, getting businesses off the ground is one area, but what happens to the business next? And this is something that you need to plan at the very beginning. And I am very pleased to have with me today Lake Falconer from Alpha Corporate LLP. Now, Lake is a very experienced exit strategist and implementer, and has helped many, many businesses go through the process of both selling, MBO, buyouts, you name it. If Lake hasn't helped a business through the process, then I don't think there is a process that exists. So I am now going to hand over to Lake. Now, don't forget, you can ask questions during the course of this webinar using the Q&A. And Lake, would you like to introduce yourself and give us a little bit of background and to fill out the gaps that I have left?
John, thank you. Thanks for that. And congratulations on how much you guys have achieved so far with the program. Yeah, a brief introduction from me, mini bio, if you like. I'm a chartered accountant. I had what I still think it was the good sense to escape from the world of auditing immediately on qualification, and went into venture capital, private equity with 3i. Where I had a fantastic time backing all sorts of businesses and transactions, but also within that, a number of successful startups and growth businesses. So great insights from that. Most of my career, though, has been as an advisor to SME business owners, helping them with M&A, buying businesses, selling businesses, with buyouts, succession, this topic, exit strategy and exit planning, and valuation. So I'm still doing that. I'm now working as an advisor and also as a non-exec or board advisor, much more directly with companies going through that kind of journey. So my focus, I think, in all these circumstances is around value. What is it? How do you maximize it? And how do you monetize it? So the agenda's up there on the screen. What I hope to bring you today is an overview based on my experience that can help you map the route ahead as you start or scale up your business. So a brief look at the M&A market today. What's it like? Give you some insight into the dynamics. Why is exit strategy important at early stage? Exit planning as a lens for driving the company forward. What are the exit routes, exit options that you can take? And then some thoughts on timing. So first off, just to dive in then and have a look at the market. This is data from Experian, looking at UK deal activity and value and volume from 2013 right up to 2022. Focus on the bar chart, that's the volume. The value swings wildly because it gets influenced by mega deals. So for things like the sale of ARM. So you can see that it's been a little bit inconsistent, but broadly an upward trend and fairly flat over the last couple of years, but doesn't look like any panic. There's the East of England data for the same period. It's been really quite consistent, hasn't it? In the last couple of years, it's been up. I think you would probably say that the trend line is more of an up across that period. So broadly, it's a nice sustained background. There will be someone out there who will buy your business in due course. What about the price at which these deals are happening? Well, this is data from BDO. This is their private companies price index and private equity price index. So this shows the multiples that people are getting when they sell their business. The black line is the stock market, which as you can see is all over the place because it fluctuates wildly. The unquoted companies, which this index focuses on, as you can see, are much more consistent. The red line is the private equity deal prices, and they, during this period, which is from the middle in 2019 right up to date, have been paying a little bit more than trade and strategic buyers for businesses. So the orange line at the bottom is strategic buyers. And it's been fairly consistent. It's probably sagged a bit since the back end of 21, but not hugely. So it averages out around about 10 at the moment. Bear in mind, this is an average of all companies of all deal sizes. If you want to know what your business is worth, you have to be much more granular with the data. So that's the history. Of course, they always say history isn't a predictor. I think the best way to get a prediction of the coming market is people survey whether people are feeling bullish about doing deals. So this is data from Intralinks, which is a data room provider, basically asking deal doers, M&A professionals, what do you think is going to happen? Quite difficult to digest on screen. So if I can just pull out there, that's European data. Basically, the red block is the folks that think deal doing will be at the same level or increase over the next year, which is 75% of them. And actually, the US data is more like the low 80%. So the deal doing community is pretty bullish about 2023, and that's usually a pretty good indicator. So I know not many of you will be thinking about selling tomorrow, but it's nice to know that the market is pretty positive to start with. So what about exit planning, and why is it important at all stages in a business? Well, it's about checking that your ladder is leaning against the right wall, frankly, in terms of your direction, strategy, and your planning. You don't need to focus on the upper rungs, the later stages of your business development right now, but you need to know you're going in the right direction. When you start and scale a business, the focus is very much about the exciting possibilities for growth, but it is, I think, important to know where you're going. How will the owner transition out of the business? How will you realize the value that you built? So the exit strategy has a number of benefits in this context. So the first one I got up there is it's a guiding path for decision making. You need to envision how your business will need to change or evolve. Think strategically, who's going to buy you? What will make you attractive to them? Align your short-term goals with your long-term exit plan. I can give you an example. I sold a software business in the telecoms sector where we did a strategic review. They had quite a lot of nice business verticals running, but it was pretty obvious that only one of them was going to be really valued by buyers, and it actually was the one where they had most growth in. So the conclusion of that survey was, look, focus on that, drill down on that, and de-emphasize the other bits of the business. It can also be a framework for other critical choices. If you're going the other way and thinking about, will I move into an adjacent market? Well, the answer might be maybe not, because it might dilute our efforts. Or it might be, yes, it's positive, because buyers would look at that. So it gives you an idea about shaping the business. Second bullet there, it's up about maximizing business value. Have you got clear business objectives and milestones and value? Do you know what your business is worth today? Would you like to? What will it be worth in 3 years' time? What's your target exit value? And just as importantly, what must the business look like to hit that value? And incidentally, if anyone wants a quick take on what their business is worth, I'm happy to have a chat offline. So an exit strategy is a roadmap to increase the value of your business over the life cycle, adding the bits it needs to have. So maybe adding IP, recurring revenue, focusing on working capital dynamics, the brand, the people. I'll give you another real life example. I worked with an engineering business where it had some nice IP, but it was mostly distribution. And the emphasis out of that strategic review was build the people to generate more IP to dilute the wholesale sort of reselling business, which they did. And it very much drove an uplift in the value of that business when I came to help them sell it. Have an eye to value at all times. Drive the value, it will help attract investors, and it will give you the right priced exit. Talking about investors, they like entrepreneurs with a clear vision and an exit strategy thought out, with a compelling narrative on investment returns and how you're going to get to them. According to the British Business Bank, angel investors, and I know that's quite a lot of the community here, split roughly 50-50 on whether they see their investment period as more or less than 5 years. But actually only 20% of them see them holding more than 7 years. So it's very much the timescale for exit strategizing when you're presenting and pitching. And if you're raising money from private equity funds, in my experience, at some point when you're pitching to them, when you're in the room, they will want to hear your ideas on who you think you'll sell to, on what the exit will be. And if they don't buy that narrative, it'll put them off big time. I've seen it. So well worth having. The next bullet point I have up there on why this is important is about mitigating risks and contingency planning. It's stating the obvious to say that business is dynamic and there are unforeseen risks, but exit strategy can guide your contingency plans, mitigate risk, help you with resilience. And finally, don't overlook your personal goals and your professional goals. It isn't all about money. Entrepreneurs rightly have personal goals too. I'm advising a business at the moment. It's a consulting related business on a sale, and it's very much about the two directors staying on after it's sold and finding the right buyer to help them exploit what is a current fantastic market opportunity for them. And we've kind of got that down to a choice between a private equity buyer, a US private equity buyer who's doing a consolidation in that market, or a European trade buyer, which will give them a very different experience after the deal. And so there's a debate going on as to what really matters. I think I know which way they'll go because they've got quite clear ideas because they've thought about this before, which obviously helps. So thinking about exit when you start or early stage seems counterintuitive. But of course, the problem is you do all your business plans at the start, and of course, very few plans withstand contact with reality. So the analogy I like, and this is the reason I've got that image up there, is your business plan is your roadmap for how you think you're going to get there. Your exit strategy is your compass, so that when you come across a problem where the road's closed or there's another obstacle in the way, you can be flex. You can flex your plan and be resilient. And then, of course, anything that makes the business more exit ready will make it a better, more resilient business. So your business plan is helpful. It's how you think you're going to get there in steps. Your exit strategy is your compass for where you're going. So how do you go about exit planning? So this is to take you through the thought process, because I think it's useful whether or not you're about to do an exit plan or whether you just want to reflect on some of these things in the context of your own business. Two approaches really depending on when. You can do an exit planning review, which is a rather more fulsome thing, to 10 to 10 years out from an exit. Or if you're about 18 months plus, I would say it's more of an exit readiness review, slightly different flavor. A full exit planning review, you need to be thinking about the personal drivers of the business owners, as I mentioned. What's the M&A activity like in your industry? What are your trading history and prospects? What about value drivers? What will drive value? What will push up the multiple or depress the multiple you get? How will a buyer look at your business? And then what about your valuation and price expectations? What are the different exit choices that you might make, and how practical or desirable are they? Today, I'm going to look at some of these. I'm going to look at, and we'll come on to that in a minute, what some of the actual exit options might be. And then finally, what about timing when you're looking at readiness? And by the end of that, what should drop out of that is some key strategic actions with timing and responsibilities attached to them. In contrast, the exit readiness scan, much closer to exit, close enough that you can have visibility of the market and the business cycle, but far enough out to still do something about any weaknesses in your business story. The key questions at that point would be much more around, is the timing that you propose still right? What's happening in your company's market? What's happening to valuations in the sector? Are they still attractive? How are they trending? Is your original exit route still practical and preferred? What else can you do to capture more value in the time that remains? And going beyond that time, have you got a pipeline of value creating initiatives that could extend after the sale that the next owners would benefit from? Ideally, you want to leave gold in the ground, future growth potential for the next guy, because he'll pay you more for the business, hopefully, inherent reflecting the growth. So here's a slide which actually comes from a real life but anonymized exit review that I did with the business, and it splits into two halves. Top half is the current state, future state analysis, and below that there's radar charts on the key points that drive value. So at the top, the idea is you've identified the key facets of the business. Here it is now, here it is as it needs to be on exit, and of course in between what should drop out is the key actions that drive your strategy. In this business, this was a technology and technology services business. And in this business, the actions were mostly to address the imbalance between the larger, lower margin service business they had and an IP, intellectual property driven products business. The radar charts below are based on specific data points, which a number of surveys in the US have shown will influence multiples when you sell. So it's the kind of what drives value. And on this chart, 5 is high, 1 is weak. So this was, when we looked at it, a business with great customer satisfaction and growth potential, but initially it was weak on dependence on the owner and defensibility for what they had. By the end of this planning cycle, of course, we were forecasting them having built a second tier management, improved profitability, and built some recurring revenue. What actually happened is before they got through the cycle, it was sold successfully. The products business was sold to a tech buyer, and the services business was hived off separately into a management buyout team. And that shows how you can really make your strategic exit planning work. Now, another key bit of the exit review is to think about how would a buyer look at your business. It's a very different kind of lens. And here's what I think are the key things a buyer will think about. Financial performance, obviously, but how sustainable is it? Is it risky? Is it scalable? Growth potential, that's more on the scalability. Keep coming back to that. What synergies are there with me as the buyer and with my customer base and your customer base? People were very keen on there being no dependencies in the business. No absence of dependencies on the owner, suppliers, or customers is key. A positive cash flow cycle. If I grow your business, will it need me to tip in more cash to fund that? Customer analysis will be important. People will want to see, is there any concentration? How unique is your offering to them? How loyal are they to your business? And linked to that, have you got recurring revenue? What's the sort of, is it consistent? Intellectual property, of course, is important, very much with tech businesses, and it's about intrinsic value. Key employee retention. What's the continuity like in the business? What's the business's relationship building like? And your sector, are you in a growth market? Have you got exposure to imports? What's the M&A activity like in your sector? And finally, of course, brand, if it's critical to your revenues. So that maybe gives you some insight into how you would think about a business when you're doing an exit strategy and some of the things that you might reflect on. What are we aiming at, though? What are the potential exit options. Well, here you go. Here's what I think are the key possibilities. Liquidation, generally bad news, obviously, but sometimes if you've sold your trade separately for technical or maybe tax reasons, liquidation will be the way to get the cash out of the company into your own personal hands. Employee deals, the next two are the acronyms there, EOT for Employee Ownership Trust and MBO for Management Buyout. These address succession, reward and retention for the people within the business. They do similar things, but they have quite different tax benefits. I'll talk about that in a minute. Merger or negotiated sale. Actual mergers of equals rarely occur in my experience. When people talk about mergers, it's because they don't want to admit they're being taken over. So usually it's a negotiated sale. Someone knocks on the door and says, I want to buy you. It's kind of difficult to get competition into the negotiation, but you can still do a good process. I call that negotiation support, and I'll talk about that in a minute. And then the next two are similar, a sale to a trade buyer or private equity. Often that might be engineered via a confidential auction, and it will probably get you the best price, but there are pros and cons. And finally, an IPO, a flotation. It's complex. You need to be big enough to do it, but it can give you the best price. And of course, if you plan to go on and make acquisitions, it's useful to have quoted paper. And that's the one I'm not going to talk about today, just to give us a bit of focus, and because it's probably most companies will exit through the other routes. But again, happy to take that offline if someone thinks they're going to float. So let's just have a look at each of these in turn. So first off, the trade sale. There's two ways that you can achieve that. One is the negotiation support, the negotiated one-to-one conversation. The other one is a full marketing where you effectively auction the business. So the negotiated arm wrestle with a buyer. This is where a strategic buyer knocks on your door. How would you feel? Would you be prepared? What kind of first impression would your business make? There's only one buyer, so it's harder to get competition. But what you can quite often do, and I'm doing this on a couple of deals at the moment, is you just add in 2 or 3 more, which gives you some competition, but without the full process. I've seen a lot of these door knocks in the last few years. That really indicates how active strategic buyers are at the moment. So that's a negotiated sale. Your other alternative is actually to auction the business covertly, because obviously you don't want to wash your linen in public. The aim here is to get multiple motivated buyers in real competition for the business. It's truly competitive. You see the best offer being much better than the lower. You see people improving their offers. Typically takes 6 to 9 months to do. Right now, probably a bit longer sometimes. And as you go through the process, you're talking to fewer buyers, but they're getting more information about your business. So it does need to be controlled. So to talk you through in big picture terms, what a disposal auction looks like, broadly 5 steps. Now I could go on all morning about this, so this really is just the edited highlights. Planning stage, obviously, you look at alternatives like buyouts and employee trusts. You think about your tax. Is there anything else from your exit planning review you should be doing? Second stage is packaging. That's getting your act together for the sale. Prepare a good selling document, an information memorandum, the book that describes the business for sale. Obviously, it has to have good numbers, but most importantly, it has to have a good story. The narrative is more important than the numbers, I think. From that, you'll distill a 1-page summary, which is anonymized. People call it a teaser or a flyer, and you use that when you go cold calling, approaching buyers, putting the business out there. How many buyers should you approach? Well, the big brokers out there who just use databases will tell you it should be hundreds, which is nonsense. Obviously, it shouldn't be just single figures. I think the right answer is tens of buyers, and whether that's 30 or 70 will depend on the business. You need to be thoughtful about it. One size fits all is not the right mindset for this. You then approach people, and it's about reaching out through phone calls or whatever works to the chief exec, M&A director, finance director, someone within your target buyer to have a discussion, to get them to sign a confidentiality letter, after which they can get the information memorandum about the business. And then, of course, to push them to have a meeting with you, the owner and seller, because that's when you'll really sell the virtues of the business. On the back of that, you're then going to put a deadline in place and say to people, I want your best offer. Offers come in the form of letters of intent, which provide quite a lot of information, but they're not binding. And at that stage, that's where, well, frankly, it can be nerve-wracking, but also a bit of fun. That's where you can have a bit of sport when you actually play them off against each other to get the best offer. And then you get to the final stage with the closing stages. That's where you bring your lawyers in. You really do need to have a good corporate lawyer because, of course, you'll give warranties and indemnities about the business. This is where all the documentation will pop up. So the sale and purchase agreement is the main contract document, usually done by the purchaser's lawyers. And the last thing that pops up here, there's obviously negotiation points right the way through, but the big one is often to do with the balance sheet of your company. People typically make offers for businesses, quotes, cash and debt free, which basically means if your business is worth $1 million and it has $1 million of cash in it, you'd want me to pay you $2 million for it. Same business worth $1 million, cash and debt free, but it has $500,000 of debt. I'm only going to want to pay you $500,000. But that cash and debt free assessment is done subject to you having a normal level of working capital in the business. Some weasel words there, because of course working capital goes up and down. And it can be quite extreme. If you sold a fireworks company after bonfire night, you would have loads of cash. But if you were buying it, you would want some of that cash held back. I had a good example myself when I sold a business that was making wooden pallets, importing timber from the Baltics. We signed the deal, took quite a long time to close, during which the dynamics of timber importing changed. So they went from bringing it in from the Baltic, which meant they had to pay for it up front and then have it on a ship, which meant they had loads of stock and they didn't have creditors. The way the timber pricing went, they switched, meanwhile, to buying in the UK, which meant they got 60 days credit and they didn't have to hold stock. So, of course, they ended up with a lot more cash. And we had a real arm wrestle about how much of the cash we as sellers got to keep. So that's important. Don't lose sight of it. There's money to be won or lost right at the end. So that's how you go about trade sale, a couple of flavors. Moving on to the buyout. And I'm not talking here about buyouts where a business sells it's to manage a big corporation and you work there and you buy it. This is more about as a vendor initiating a sale to your team. If you have a stable, profitable, growing business with a good team, it's a viable option. You can get more control perhaps than selling to the trade. Basic structure might be familiar to some of you. You sell 100% of the company to a new shelf company for a fair price. You do it right, you get capital tax treatment, same as with a trade sale, so you're only paying 10 or 20% tax. And it gets funded by any cash in the company, by debt, by perhaps a loan from you as a seller, or private equity investors. Management team, you want them to invest some cash to make sure they're committed. Practical points, there's loads of funding for this at the moment. The private equity guys are well up for it. The banks will lend 2 to 2.5 times EBITDA, even in the current climate. Key thing I would say is don't just let your team have a go. I've seen people say to the management team, you go away and try and put a deal together. Don't do it that way. Keep control as a vendor. You can structure it. You can choose the price and the timing to suit you. And also it doesn't distract and worry your team meantime. So you keep control. And make sure that the deal is structured so as not to burden the business. There needs to be some flexibility in the structure. I always go on when I've talked about these succession buyouts to mention employee ownership trusts because people tend to mention them in the same breath. The picture there is of John Lewis, which of course is the poster boy for employee ownership. Although in fact it's not an employee ownership trust, it's under prior legislation. But the way the trust works is you must sell at least half the company to the trust. It's very tax efficient if you're a seller because you pay no tax at all, which is lovely. The aim is long-term employee ownership, but the flip side is very unfavorable tax treatment if you tried to sell it later. Funding is similar to buyouts, but private equity is unlikely because there's no easy exit. Certainly going to be difficult. And the other key facet is that the employees, as well as indirectly benefiting, they can get $3,600 per annum tax-free bonus. Key conditions, employee ownership trust must benefit all the employees on the same terms, and the target must be a trading company. I think you need to think about the cultural suitability of your business before you jump on one of these. You might need a different culture if it's genuinely all employee. Think about motivation. Do your employees feel any different? Do managers have enough skin in the game? And I've heard both stories from people who've done these things. You need, I think, to value your continued independence, because the disincentive to sell might act as a poison pill, or it can limit strategic options. So you need to want to be John Lewis in perpetuity, really. Brief compare and contrast of buyouts and employee ownership trusts. The key difference is the tax is better on the trust deal, but on a later exit, the buyout is better. As regards senior team motivation, and I should say these are all very much my opinions on this, but I looked at this a lot. I think senior team motivation is better on a buyout because they have skin in the game. You can customize better on a buyout. In terms of culture retention, I think that's slightly better in a buyout, because for employee ownership trusts, for most owners, most owner-managed businesses will require a culture shift if they're going to trust. It's a much more custodial environment. And finally, as regards the motivation of people across the company, that's always important, isn't it? I think if you do it right, that's probably about the same, to be honest. So they're quite different, superficially similar, but quite different responses to the same question. Finally, private equity. That can be a good way to sell, or it can be a good way to get a partial exit. Often they'll buy a majority of your business, but leave key managers in place. Some of them, BGF, for example, will potentially write a big check to buy a minority stake in your business to allow you personally to de-risk. And if you get the right one, you're also getting smart money. They can bring some knowledge to your board table. They do typically prefer businesses making at least $1 million of profit and with a consistent track record. It will bring a change to the ownership style of the business, and it's very much predicated on a later midterm exit. It will introduce a different structure of funding to the business, of course, including a lot of loan notes and preference shares with funny rights. It will need management to stay in to manage the business, or if you're wanting to exit as the originator, that will need to be managed. And you'll pick up some other costs along the way, like board fees and monitoring fees and so forth. There is a lot of appetite right now for private equity funds to invest. Indeed, some funds, because of the way they're structured, actually have pressure to get money invested by a certain timetable, whether or not there's war in Ukraine or inflation or whatever. So plenty of money. If it's something you want to look at, you'll have lots of choice. Whichever route, however, that you do choose, timing is pretty important. So there's the key options on screen there. As regards timing and how you assess it, it's typically more about what's happening in your market and your business than the market as a whole. That's what drives it. And I like to use a kind of traffic light system when going through the sort of key facets of timing. So this is a this is a made-up example, actually. And the idea is you could have various criteria you think are going to be relevant and try and assess how it works for you. So in this example, green, of course, is green light is all systems go. That's positive. So in this example, for example, the sector is good. So that probably means that there's lots of buyers in the sector. Prices are looking buoyant. This business also has good second tier management. So it probably is a good story in terms of the owners getting out. And the current tax regime, well, it's not quite as good as it was, but frankly, it's still as benign as it has been in terms of the tax that you'll pay on a capital receipt. This one has uncertainty around Ukraine as being more of a pause potentially, and also the financial performance. Tax regime is probably common to all businesses. The other one that's probably common to all UK businesses is relatively weak sterling, driving the interest of foreign buyers. So that's the kind of discussion that you would want to have when you're at the point of thinking, right, okay, I'm about to dive in and try to sell the business. You probably want to have it through the life cycle, through the exit strategy, but you want to be really specific if you're thinking, actually, I now want to push the button on the sell process so that I can sell over the next year. So to try and pull the threads together, it's a bit like a battlefield out there, isn't it? In terms of what's going on business-wise. But I think it's worth, when you're thinking about exit strategy and strategy generally, to take a lead from the armed forces. As I understand it, battlefield strategy works as a series of iterative loops. So what I would suggest is get your strategy going and keep testing it. That's the idea that you know, you need to look at multiple scenarios. If things are moving fast, reforecast more often. I think I would say that that was something that really bubbled up to the surface during COVID. Of course, it was so uncertain, wasn't it? So people were reforecasting and reforecasting, and that's carried on to some extent, partly because it's a useful discipline and partly because it might not be quite so exciting, but times are still a bit weird. So to summarize, I'm seeing lots of activity in the market. It's still pretty positive. So all of these exit options are very much available to you. It's never a bad time to make a sales call, they say. And I think you could say the same about exit planning. It's always the right time to think about your exit planning, whether or not you're thinking about selling in 3 years, in 5 years, arguably, even if it's not on your agenda at all, because anything that you do to make the business more saleable will just make it a better business for you, even if you keep it. So I would say don't let either being sucked into the business or the current crisis, don't let anything deter you from making plans. Ultimately, this is about finding an exit of your choosing at a time of your choosing. Or if you've got investors on board, obviously you and your investors making those kind of choices. I love to hear about people's plans and challenges and what's going on. So genuine offer here, if anyone would just like to have a chat about your plans through scale up to exit, please do just get in touch, just connect on LinkedIn and let me know that that we met in this webinar. So I hope that's given some useful insight and thinking to folks out there. And I will hand back to John now.
Thank you, Lake. Thank you very much indeed. Very informative. And whilst we're whilst we're collating the questions, I'm going to throw one over to you. It really goes back to the very beginning when you start talking about multiples, 10 times the value, that sort of thing. Be a little more specific. Multiples of what?
That's a very good one to bring me up on, because I did just skate over that, didn't I? In the example given in the data, those are multiples of EBITDA, which is earnings before interest, tax, depreciation, and amortization. Broadly, it's a bit roundabout operating profit. And the reason that M&A advisors like that is it's quite close to cash generation in a business. But if you're selling an early stage business or a tech business, or I'm about to sell a software business, the conversation might be around turnover multiples because people are interested in what they can do with it. So it's usually a profit multiple is the short answer. And within that, usually EBITDA. But you can't ignore turnover multiples. And in some businesses, particularly high growth or tech driven, turnover multiples are also relevant.
Thank you. Question from the floor. How useful do you think are advisors, brokers, and introducers? I'm not going to make a comment there. Does a direct approach depress your negotiation power?
I think advisors are useful, and I always say to people, I don't care whether you, well, I do care, but I'm more worried about you actually doing the best out of this deal than whether you hire me. There's all sorts of benefits. You have basically, if you get a direct approach, people do deals sometimes, and of course business people are used to negotiating, but it's a very particular negotiation, and it is also useful to have good cop, bad cop in these situations as well, to have a sounding board, to give context for what you're being told by the buyer. You know, you might spend your life building a business, but that's not the same as buying and selling a business. And the other thing, of course, to say is most people only sell businesses once in their lifetime, or they only sell a particular business once. So it's important to get it right. So I would say, really, you shouldn't be doing it on your own. You don't have to use an advisor to do everything if you're pretty capable. If you've sold a business before, if you have an investor who's sold a business before, you can dial up or down the extent to which you need input from an advisor. But it's too important a transaction not to do it as well as you can.
And I think you're quite right. Advisors are there to advise, and you should listen to all advice, but take your own decision always in that case. I've got another question. It's a bit more technical here. How do you feel about a pack M&A? Are there any special precautions?
In a sense, that's it's a cash buyer by another name, isn't it? I think you would probably want, even more so than with other buyers, to feel that you can ask them questions. You can do diligence on them. Who actually stands behind it? Where does the cash come from? What are their intentions for your business afterwards? It's easy to think that it's all about you telling the story of your business to get max out of people. But actually, and particularly if there's some ongoing involvement or some cash that you're not going to get up front in your bank account, it's absolutely legitimate for you to grill the buyer as well. It's a two-way street.
And do you think, I mean, when it comes, going back to the question about professional advisors, I mean, say you mentioned brokers and what have you, but do you think it's best to have an accountant and a commercial legal lawyer on speed dial when you're going through these negotiations?
Yeah, you need a lawyer. I tend to keep the lawyers out until we've agreed the letter of intent, because with the best will in the world, they get lawyerly and it tends to slow down the discussions. But after that, you absolutely need to have a good commercial lawyer working hand in hand with your corporate finance advisor, the guy who's been helping you put the deal together. And the right advisor will know when to bring the lawyer in, because there are occasions when you need a lawyer earlier, because frankly, something comes up that they have to address. But for the most part, I would suggest you get to the point of signing a letter of intent with your buyer before you bring the lawyers in.
Because of course, a letter of intent is not actually legally binding per se.
No, you need to be sure. You need to be sure that you're probably going to do what it says, because you know it is a handshake. And if you try and wriggle out of it, I promise you, people will say, "No, I'm sorry, you can't do that because it says this in the letter of intent." I promise you, that's what they'll say to you. So you do occasionally need to get a lawyer in at letter of intent stage, because a buyer might stick something in that looks a bit scary and legal.
Mm-hmm. Okay. So in your, I mean, so you touched on it as you were going through, and you were going through the process, and you skimmed over the process, which is quite appropriate at this stage. But of course, you left the door open for anybody to contact you, and we can share your contact details. They've only got to contact UEZ, Uniform Echo Zebra, at essex.ac.uk, and we will pass the details on. But when you've been looking at businesses and valuing them, would you, if someone approached your business and said, "I want to buy it," do you think you ought to go out and get an independent valuation straight away?
Yes. If I can split hairs slightly, you probably want to have a discussion with someone about what a realistic price would be, because it's not quite the same thing. A value is a valuation is the answer you get with someone who looked at the whole market and said, what's a kind of sober view of your business? The price is what you would think you might get if you know who's buying. Otherwise, if, for example, you're selling a business that, I don't know, is geographically linked and it has a cracking base in Essex, and you've been approached by a buyer who has good UK coverage but has nothing that side of London, well, you know why you're strategic, don't you? So you might think you've got a bit of leverage. So I do think you need to develop your idea going into a negotiation, because otherwise you're just going to ask for more, aren't you?
Or less, as the case might be, and undersell itself.
And you also don't want to ask for a bonkers number as well, because that will just put off the buyer. Unless sometimes you get approached by people and you think, well, I don't really want to do the deal yet, but equally I don't want to show that unwilling, in which case you might pump your number in the hope that it's too high. Mm-hmm. And obviously if they come back and they want to pay it, then hey, we're off to the races.
If you don't ask, you don't get, is the old
correct,
phrase, isn't it?
Correct. Okay. But don't frighten them off. That's the only thing, if you are serious about doing it.
Yeah. There's a question come up about IP, which I think is relevant. How do you value your own IP when it is very high tech and little understood by your potential buyer?
That's a difficult one, isn't it? Because I guess my question in return would be, why does your buyer want it if he doesn't understand it? I think the challenge is probably, how do you get full enough value? If you've got IP that is truly revolutionary. You've got a communication job to do, I think. People need to understand why in terms of the science, but also in terms of the potential market exploitation, why it has upside. You do see businesses being sold, sometimes pre-revenue, for astonishing amounts because they've got significant IP. But that is because the buyer can clearly see value and understands it. So that is a really good question. And I suspect you're probably not going to be talking to a buyer unless they're capable of understanding it. You probably have to help them understand it. So it's a real focus of communication, and it might in fact inform part of your exit strategy is actually over time building up the way that you as a business communicate the value of your IP, which probably meets your objectives to grow it as a business. But there's no harm in thinking at the same time, how do I get that across to a buyer? How do they value it? I sold a software business once which spent years paying quite a lot for advertising on key pages in trade mags, actually largely with a view that they wanted to get the rest of their community to understand what they did, because they had half a view on when they sold it. The guy who ran it had already sold a business and had a problem with that before. And it meant that when they went to market, everyone knew them and what they were for.
And that's very good awareness raising, isn't it? Let's face it.
It is. I mean, to be honest, I wondered why he was spending so much on it, but I have to say, having seen the end result, he was right all along.
Yeah, and there is another old proverb I come out with, is who you know, who knows what you do. Yeah.
Yes, absolutely. Yeah. So really, really good question there, because it's all about communicating value. It's not enough just to have value. The next guy needs to value it.
Yeah. Well, this is going to bring an end to our presentation today. Oh, no, I spoke too quickly. Must you always like your buyer?
Helps. I think in practice, I've found that where people get offers that are broadly similar or not wildly different, they will choose the buyer they like. So I've got one at the moment where I think that's probably what they'll do. I have seen people hold the nose and sell to buyers they're not entirely confident about. But I think what you would find is you would raise the bar in terms of how much money do I want to get for my business and how much of it do I want to get up front. I've seen people basically want to turn off conversations with particular buyers because they just don't like them and don't trust them. And it is about people. You probably have to follow your instincts. So to summarize, money talks, but only so much. So I think you do need to, I think it really does help to like your buyer.
I think I agree with you, because the businesses I've sold myself personally, ones that I've owned or helped to sell for others, it has helped when you like the buyer and you build up a certain amount of trust, as much as you can build up trust with a sale.
Oh, absolutely. I would observe that goodwill is really important in the sale process.
Yeah.
You know, some intermediaries that I've who will remain nameless tend to take a pretty aggressive, constantly chipping away barrow boy type of approach to the process, and it just pisses off the buyer. So when you need a favor later on, or when you need to lean on something later on, they're going to be less open to it. I always say, build goodwill throughout the process. It will pay off before you get to the end.
Yeah. And I must admit, there have been occasions when I've turned a blind eye when it's come to selling the business, on the basis that I just want to sell the business.
Yeah.
And
we're nearly there. Let's just get this done.
Yeah, and move on. Okay, and moving on, I will now close the Q&A, and I will take some time to thank Lake for his presentation. As I say, Lake has very generously said that the door is open. So by all means, contact us. I'm going to ask Victoria if she could put up the ending screen, please. Screen share, please, Victoria. And introduce our next webinar, which is actually with Simon Attack from Innovate UK Edge Programme, which is a free service provided by Innovate UK. And the advantages of using this is that they go through the innovation model canvas, which is really an excellent toolkit for determining how to value your business and make sure that it meets all the requirements that Lake was actually putting out there regarding where are the weak spots and where are you strong and how can you improve your business to that point. So very much filling out that chart that Lake presented earlier. But also Innovate UK, of course, are the holder of money. They have Innovate grants, they have Innovate loans, they have investor partnerships, they have a whole host of funding streams, which are alternative funding for your business. So yeah, stay tuned for Simon, same time next Thursday at 2 o'clock. I am now going to close the webinar. I am going to say thank you very much indeed, Lake, and thank you very much for Victoria for helping out with the back office. So once again, my name is John Stenhouse. This is the University of Essex, Investment Readiness from Angels at Essex. Thank you so much. Thank you, everybody, and goodbye.